Yo, what is up, my Nakama? So my name is Daniel and I'm a first year medical student, and in this video I'm going to talk about long-term dividend investing for college and medical students and whether it's worth even starting it right now. Let me preface this video by saying that I am not in any way a financial advisor. I've never taken a single economics course. I'm just a medical student training to become a physician, but I think that it's important to take finance seriously and that the earlier you start, the better it is going to be in the long run. So I began investing into the stock market 1 month ago on March 1st, and I know probably not the best time to start investing in the stock market considering how everything has been crashing essentially. I read a lot, I educated myself, I watched a lot of videos, I read a few articles just about the basic principles of stocks, how investing works, how compound interest works, how dividend payment works. And after educating myself, I decided that the strategy that I wanted to use was called long-term dividend investing. Now, the reason I chose long-term dividend investing is because of two reasons. First, I wanted a way to make passive income basically no matter what situation we're in, like whether we're in this pandemic or when the economy isn't doing too hot, I can rely on my passive income to get through financial hardships. And by receiving dividend payments from high-paying dividend stocks, that is a way to generate passive income no matter what's happening during the economy, at least as long as those dividend stocks don't fail, of course, which I'll get into later in this video. Now, the second reason I chose this type of strategy is because I'm okay with short-term losses. So even if a company is doing poorly in like a 2 or 3 month time span, as long as the company is going to be successful in the long run and continue to pay dividend payments to their stock owners, then I'm totally okay with owning a company for like 10 or 15 years. Because for me, I'm not really looking for extreme short-term gains. I'm looking for kind of less risky options and more long-term investing that can generate passive income when I'm 30 or 40 years old. So with this in mind and my own personal goals, I decided that long-term dividend stock investing would be the best investment strategy for myself. And the best part about it is that the earlier you start investing, the more you're gonna make in the long run, which is why I think that university students and medical students, they should seriously consider at least contributing some small amount of whatever income they have or whatever savings they have into investing rather than having it sit in the bank and really do nothing and actually depreciate in value as interest rates go up anyways. Okay, so just to explain things as easily as possible for those of you who have no idea how the stock market works or what dividend stocks even are, let me give you a basic example involving Disney. So I actually own 2 shares of Disney. So what this means is that I own a very tiny sliver of the entire company of Disney, and that sliver is 2 shares worth. And those 2 shares, let's say I bought them for $30 or $30 a share. Now what Disney is going to do, because I own and hold on to the stock, is they're going to give me something called a dividend payment, which is essentially a percentage or a portion of their stock price that they pay out to shareholders for just investing and holding on to the company, which is awesome. It's kind of an incentive to actually invest in a company in the first place because their revenue they're going to give out to their shareholders in what is called a dividend payment. So let's say I bought 2 shares of Disney for $30 and they had a dividend payment ratio of 2%. This means that for each share of Disney that's worth $30, each month Disney would pay me 60 cents. So because I own 2 shares of Disney, they are going to pay me $1.20 total for just owning the stock, just being a shareholder, which is awesome because that's $1.20 that I didn't have before. And as you might come to see, the more shares you own, the more dividend yield the company is going to give you in the first place. And as you own more shares and as you buy into the company more and more over the long run, your dividend payments are going to increase, hopefully exponentially, and your returns are just going to be very good. Now, the cool thing about some brokerages, which is essentially the system you use in order to actually buy the stocks, is that some brokerages allow you to take the dividend payments that the company gave you and reinvest it back into the company for a fractional share of the stock price. So let's say that Disney paid me that $1.20, but I didn't actually want to take it for myself. I wanted to reinvest it back into Disney again. So I would buy whatever fraction of the share $1.20 is worth of Disney. And this is kind of how you see compound interest and increased returns, because as you continuously reinvest your dividend payments into the same company, you're going to be making more dividend yield as a result. And this is kind of a cycle that will compound and generate more revenue and income in the long run. And this is really the beauty of dividend paying stocks. Pretty much the longer you hold on to these stocks and the more successful these companies are, the more you will be paid as a shareholder for investing in the company. Now, this all works, of course, if you hold on to the company for a very long time, which is why I decided to start dividend investing now while I'm in my first year of medical school. And I kind of wish I started earlier, but to be honest, I had little care in regards to finance, but now I think it is very important to take it seriously, because you never know what's going to happen to yourself or to your investments, or who knows what's going to happen. There might be another financial crisis like 10 years from now. But as long as you have solid investments and a good strategy and not panic sell, then I think you will be in a good place. All right, so now that you know a little more about how dividend stocks works and what it means to actually own a share of the company and have them pay you a dividend stock, I want to go over how I choose what dividend stocks to choose from and what companies to actually buy, of course. So first off, if you're going to do long-term dividend investing, you need to make sure that the company pays a dividend payout ratio. So some companies, they don't pay a dividend yield. So just because you own a share of the company doesn't mean that they are going to give you a dividend payout ratio. So first of all, you need to make sure that the company that you're going to invest in has a dividend payout yield. Now, the next thing you need to make sure of is how safe the company is in terms of paying their shareholders a dividend yield. So there's a few websites that you can use. I'll have one pop up somewhere here that I generally use. And with this website, essentially you'll enter the ticker symbol of the company. So whether you're looking at Disney or Microsoft, you'll enter the symbol there. And then on this website, you can kind of look over the history of their dividend payouts and also their dividend growth. So something important to keep in mind is whether the dividend growth of the company has been increasing over the years. So let's say that at first a company's dividend yield was like 2%, and then the following year it went to 3%, and then the next year it went to like 3.5%. This is pretty good. It means that their dividend yield is increasing and that their payout ratio is increasing for their shareholders, which is good for you if you plan on holding on to this company in the long run. All right, so now about the companies that I actually choose. So basically, you need to believe in the company and know what they actually do. So anyone can kind of invest in some random stocks that they have no idea what they do. But like, for example, if you invest in Intel or Microsoft and you know the products that they provide and you believe that in the long term they are going to be very sustainable companies, they have innovation, and you see them continuing into the future, and they pay a dividend yield, then these are great companies to invest in. And essentially they're known as kind of like blue chip companies. So companies, like Disney, Apple, Microsoft, McDonald's, Johnson & Johnson, basically these like huge powerhouses in their respective industries. These are very safe and very good dividend yield stocks to invest in. All right, now the next important thing to keep in mind when doing dividend investing is to have a pretty diverse portfolio. So the reason that you need a diverse portfolio is because you're not like investing in indexes or ETFs that essentially cover a wide range of different industries. You're investing in individual companies, except you're investing in a lot of them. So you'll have like 20 or 30 different individual companies that you're investing in at the same time. And you want to be investing in different sectors of the economy, because let's say if one sector starts tanking, but another does really well, then your net losses or net profits aren't going to waver that much if one part of the economy starts failing. So you don't kind of want to bank your entire portfolio on one sector of the economy like healthcare. Instead, you want to diversify your portfolio, so have some stuff like in consumerism and have some stuff in technology and have other things in like travel and industry. Basically, by diversifying your portfolio is essentially less risky than if you just bet all your money on one company doing extremely well, which should make a lot of intuitive sense anyways. Now, another important thing to keep in mind that I think a lot of people neglect when choosing a dividend paying company is, let's say for example, they see a company that pays a huge dividend payout ratio, like 10 or 20% of their stock, which seems like miraculous. That's like awesome. 20% of the stock price is going to go to you. That's amazing. But what you need to look at is what percentage of the company's revenue are they using to pay out their shareholders for their dividend stocks. So generally a safe number for this is 50 to 60% of a company's revenue going to dividend payouts is a safe dividend payout ratio. And if a company were to go over 100%, meaning that they actually don't have enough money to pay out all their shareholders, then this is very unsafe. And this is kind of a red flag on a company that you would not want to invest in if you were looking in terms of long-term dividend investing, because you want to make sure that the company has good business practices and is not using their entire revenue in order to pay out all their shareholders. So generally somewhere between 50 and 60% of the entire company's revenue is a safe bet. And if you are willing to be a little bit risky, then 80, 90% is a little bit riskier. But if you have just a few of those dividend stocks just to play it a little risky, try and get a little more gains, then that's fine. But don't have those risky dividend yield stocks be the basis of your entire portfolio. You want to focus on very stable, very good companies that you feel like are going to last a while into the future. Okay, so now that you know a little bit more about like what companies to choose from and how to determine whether a dividend stock or a dividend company is safe in the first place, you probably want to know what money or capital do you even have to start investing with. And here's what I can recommend, at least from my own experience. So first of all, I had a gap year job before going into medical school. So I did have some savings going into medical school. And until last month, I basically had those savings just sitting in my bank account, not really doing anything. It wasn't even earning money. It wasn't in like a high yield savings account where it was earning like 1 or 2% a year. It was literally just doing nothing. And I just felt like this was a little bit of a waste of my money. So I decided, to first take $100 out, then take $500 out, and then take $1,000 out and invest it into the stock market. And the reason I'm investing now, actually, during this market crash, is all because I think that now stocks are priced extremely cheap and extremely low. And I think this is actually the best time for me personally to get into the stock market, because if I were to get in like 2 months ago at the very peak of our economic performance, then I would have actually lost a lot of money. But now I'm buying stocks at like such a cheap value. And to me, even if I bought them like 2 months ago and I saw that like my entire portfolio was down 30% and I was losing like thousands of dollars, I would still not panic sell because of the whole principle of my investing strategy, which is long-term dividend investing. So I'm talking about at least, 3 or 5 years into the future. And I'm sure you know that Disney is going to recover. People are going to go to their parks, once this virus subsides. And I'm sure that Disney is going to be a very successful company in the future, which is why I actually bought a few shares of Disney a couple weeks ago. And they have already been recovering, as we can see. And I bought the stock at a very low value, which is good because although you don't really focus on capital gains, you focus more on your dividend income with long-term dividend investing. It is always good if the company is successful, of course, in the long run. Now, something super risky that I would not recommend doing, although I do know a couple people who do this, is that they take their student loans and they invest it into the stock market, hoping that they can outperform the interest rates on their loans so that essentially they're making a profit and able to pay off their student loans at the same time. And of course, this is highly risky because if you lose that money, then, well, you're kind of screwed. So I would advise against doing that type of investing where you take your student loans and try to invest it and make money from it. But, I can't control what you do, but I would not recommend that. What I recommend is just, whatever savings you have, whatever money you might get from your birthdays, or basically if you have any sort of side jobs or side hustles, just even if you can only take like $50 or $100 of that per month and invest it in the stock market, especially with long-term dividend investing, it's going to compound and you're going to see, your dividend payout ratios increase month by month and year by year. And even if you only contribute like $100 each month, that's better than nothing. And it's better than it just like sitting in your bank account and not doing anything. And yeah, basically I would just recommend, like, if you're a college student, if you're a medical student and you feel nervous about investing, which was totally my position like 2 months ago. I had no idea what the stock market was. I thought that investing in stocks were just this foreign concept that only people on Wall Street could buy and trade. But I realized that it's very simple. You know, it's just with a click of a button, you buy 2 stocks of a company and you hold on to it, and that company gives you money. So, you know, who wouldn't do that? But of course, you know, you need to research the company. You need to understand why you're investing it in the first place. And you need to believe in the company and their goals and their principles, and hope that, you know, they're an innovative company that will succeed in the future. Because, you know, if the company fails and you're invested in it, then that's money that you're going to lose through your investments. But of course, companies that have existed for 50, 100 years, like Johnson & Johnson and McDonald's, those are very safe companies to begin dividend investing in. And I would definitely recommend companies like that to have in your portfolio for a dividend income portfolio. But yeah, you know, I hope you enjoyed this video. I know it's a little bit different than kind of my regular med school content, but I just think it's super important, and it may be useful to know now, you know, during this financial crisis, that, as you know, because the stocks are priced so low now and you do have extra income or cash on the side, it could be a good idea to begin your dividend investment journey now, because the earlier you start, the more gains you're going to see in the future. All right, well, I hope you enjoyed this video. I hope, you know, you're staying safe and remaining sane during this social isolation and mandatory social distancing. And as always, Data Bayo.